Somewhere right now, a stranger just bought a tiny piece of a business he's never visited. He doesn't know the CEO's name, he's never seen the warehouse, never met a single employee. And yet, legally, he owns part of it. A real, documented, fractional claim on that business. That's not a metaphor, that's the actual mechanical reality of what a stock represents. Most people treat the stock market like a scoreboard, numbers going up, numbers going down. But the scoreboard is just the surface. Underneath it is something far more interesting. Public markets are a system where ownership of real businesses gets cut into small pieces. Those pieces get bought and sold between strangers, continuously, at prices set by collective agreement. That sentence sounds obvious until you ask, why would anyone build a system like that, and why do prices move at all if the underlying business didn't change today? Those two questions are worth holding. Both get answered, but not yet. Start with what a share actually is, because most people have a fuzzy version of this. When a company goes public, it divides its total ownership into a fixed number of units. Each unit is a share. Each share carries proportional claims on earnings, on assets, on votes. If a company issues 10 million shares and you hold 10,000, you own 0.1% of that business. Not symbolically, legally. If it gets acquired, your 0.1% gets paid out in the deal. That ownership is real, even if it feels abstract, because you're looking at it through an app. A 28-year-old guy buys 15 shares of a company on his lunch break at 12:43 p.m. He's now a fractional owner of a business with 4,000 employees and $600 million in annual revenue. He'll probably never think about it that way. But the legal structure doesn't care what he thinks. Now here's where public markets get genuinely strange compared to private ownership. If you own 0.1% of a private business, selling that stake is hard, slow, and expensive. You need a willing buyer, a lawyer, a negotiated price, and weeks of paperwork minimum. Public markets solve that problem entirely. They create instant liquidity for ownership stakes. Liquidity is the ability to convert an asset into cash quickly, without destroying the price. That sounds technical. What it means practically is, you can exit a position in seconds. The entire infrastructure of exchanges, brokers, clearinghouses, and market makers exists for that one purpose: to make ownership of businesses tradable between strangers, with almost zero friction. That infrastructure is so invisible and so reliable that most people never think about it at all. Until it breaks, and occasionally, briefly, it does. That's when its value becomes suddenly obvious. So why do prices move constantly if the business didn't change between 9 a.m. and 3 p.m. today? This is the question that confuses people most. And the answer is slightly uncomfortable. Prices in public markets don't reflect what a business is worth right now. They reflect what millions of people collectively believe it will be worth in the future. That distinction is everything. A profitable company can watch its stock fall 30% in a month, not because anything broke, because the collective belief about its future got revised downward. An analyst publishes a note saying growth will slow. Institutions start selling. Price drops. The business is identical on Monday and Friday. The price is not. That gap is belief, not math. Here's the pattern interrupt. The largest stock market in the world has been wrong about the future, repeatedly, systematically, for stretches of years at a time. And it's still the best pricing mechanism we have. That's not a contradiction. It means markets are imperfect aggregators of imperfect human beliefs. They process enormous amounts of information faster than any individual ever could. But they also process fear, greed, momentum, and narrative, none of which are financial fundamentals. A market price is the output of both mechanisms running simultaneously, inseparably at all times. Understanding that is what separates someone who watches prices from someone who understands what prices are. Now, the structure of public markets itself, because not all exchanges work the same way. Some markets are centralized, one physical or electronic location where all trades for a security happen. Others are decentralized, networks of dealers who each maintain their own prices and inventories. Most equity trading globally happens on centralized exchanges. Most bond trading happens dealer to dealer. That structural difference affects pricing transparency, transaction costs, and who has information advantages. On a centralized exchange, every trade is visible. The tape is public. Prices are broadcast instantly. In a dealer network, you call a dealer, get a quote, accept or reject it. Less transparent by design. That transparency difference matters more than most retail investors ever realize in practice. When you buy a stock on an exchange, you see the price everyone else sees simultaneously. When an institution buys bonds dealer to dealer, it negotiates a price you never see posted anywhere. Same underlying asset class, completely different information environment, completely different cost structure. This is why professional bond traders earn what they earn. Information asymmetry is the actual product. Now back to the ownership question, because there's a layer most people never reach. Owning shares in a public company comes with rights that most retail investors never exercise. Voting rights on major corporate decisions, mergers, board elections, executive compensation packages. A shareholder holding 200 shares gets a proxy ballot every year. Most people delete the email. Institutional investors holding millions of shares read every word and vote on everything. That participation gap is part of why corporate governance often reflects institutional preferences over retail ones. You technically have a voice. The practical weight of that voice depends entirely on how many shares you hold. A man gets a proxy ballot for a company he bought 3 years ago and forgot about. He still owns 40 shares worth about $2,300. He has no idea there's a board election happening. He deletes the email. A hedge fund with 8 million shares votes yes on a CEO pay package worth $94 million. Both are shareholders. The system treated them identically in structure and completely differently in outcome. That's public markets working exactly as designed, not broken, just brutally weighted towards scale. The smart objection always surfaces here. Markets are just casinos. Price movement is pure speculation. It's a reasonable frustration, but the mechanism doesn't support the conclusion. Casinos have fixed odds, fixed rules, and the house always has a structural edge on every single bet. Public markets have no fixed odds. Long-term price direction is connected to actual business earnings over time. In general, over multi-decade periods, markets have reflected underlying economic growth, imperfectly but directionally. Short-term price movement can absolutely resemble speculation. 3-month price action often tells you nothing about value, but a business that grows earnings from $2 per share to $11 per share over 15 years gets noticed. The market may misprice it for years. It tends not to ignore it permanently. That's the distinction worth holding. Short-term markets price sentiment, long-term markets price reality, eventually. How long is eventually? That's the part nobody can answer with precision. Outcomes genuinely vary, which is why public market investing, in general, rewards patience and punishes people who need certainty. The market doesn't care about your timeline. It operates on its own rhythm, indifferent to your rent due date. A 31-year-old checks his portfolio every morning before work, tracking daily moves on 12 different positions. He's measuring sentiment, noise, and calling it performance analysis. The business results won't print for another 90 days. The daily price is real. What it means about the business over 90 days is almost nothing. That behavior, confusing price movement with business performance, is one of the most common and costly habits in markets. Public markets make it easy to watch. They don't make it useful to watch constantly. So pull it all together, because the mental model here is actually compact once you see it clearly. Public markets are infrastructure. They convert illiquid business ownership into tradable, liquid, fractional claims. Prices in those markets reflect collective beliefs about future value, updated continuously by millions of participants. Those beliefs incorporate real information and real emotion simultaneously. You cannot separate the two cleanly. The exchange structure determines how transparent and accessible that pricing mechanism is for different participants. And ownership in public markets is legally real, even when it feels digital and abstract and distant. Ask yourself this: when you last looked at a price move, were you reading a business or reading a crowd? This week, pick one company you hold or follow and read its last earnings report, not its stock chart. See if what the business actually reported matches the story the price has been telling for the past 90 days. That comparison between reported reality and priced belief is where market literacy actually begins. If this framing changed how you see prices, the next video goes one layer deeper. We're looking at exactly how a price gets set in real time, the mechanics of bids, asks, and spreads. Every transaction has a hidden cost built into that gap. Most people pay it without ever knowing it exists. Public markets are not a scoreboard. They're a continuous, imperfect, collective negotiation about an uncertain future.